Everyone wants to know the same thing right now. Not next month, not next cycle. One question. Bitcoin in 2026, is it going to $250,000 or is it going to $10,000? And the fact that both of those numbers are being spoken by serious people in the same year should tell you something very important. This is not a normal market anymore. This is not price discovery. This is a stress test. And what we are witnessing right now is not speculation. It is a structural confrontation between two completely different interpretations of reality. As we close out 2025, Bitcoin is sitting in a range that looks calm on the surface. But calm is the most dangerous phase of any market. Calm is where conviction gets tested. Calm is where weak hands make decisions they will regret for the rest of their lives. Because underneath this tight range, something has shifted, and most people are still looking at the wrong signals. You are being told that Bitcoin ETFs solved everything. You're being told that institutional adoption has made Bitcoin safe, mature, stable. You're being told that volatility is dead and the wild days are behind us. And at the same time, you are being warned that Bitcoin is overextended, speculative, due for a massive mean reversion. These two narratives cannot both be true. One of them is about to be violently disproven. The reason forecasts for 2026 range from $250,000 to $10,000 is not because analysts can do math. It's because they are modeling two completely different Bitcoins. One model assumes Bitcoin has crossed a structural threshold. The other assumes it hasn't. And 2026 is the year that will settle that argument permanently. Let's start with the bullish side, because this is where most people get emotional and stop thinking clearly. The megabull thesis says this cycle is not like the last ones. It says ETFs changed the game. It says Bitcoin has moved from a fringe asset into the core financial system. And people like Charles Hoskinson, Arthur Hayes, Tom Lee, Brad Garlinghouse, Standard Chartered, Bernstein, Bitwise, they are all circling the same conclusion even if they disagree on timing. That conclusion is that Bitcoin is no longer fighting for legitimacy, it is fighting for allocation. When Arthur Hayes says Bitcoin could be above $200,000 by March 2026, he is not talking about hype. He's talking about liquidity. He's talking about what happens when global capital has nowhere left to hide. When bond markets no longer function as a safe haven, when real yields remain unstable, when currencies continue to bleed purchasing power. Bitcoin, in that model, becomes a pressure valve, not because people love it, but because they need it. Tom Lee walking back his $250,000 target down to $150,000 to $200,000 range is not bearish. It is cautious optimism. And notice what he didn't change. He didn't abandon the thesis. He didn't say ETFs were a fad. He said the pace might slow. That matters. Because even the bulls are acknowledging friction. Standard Chartered, cutting its forecast from $300,000 to $150,000 wasn't a loss of confidence. It was an admission of timing risk. Corporate treasuries didn't pile in as fast as expected. ETF inflows replaced direct accumulation. That tells you something very important. Bitcoin demand is becoming intermediated again, and intermediation always introduces fragility. Now look at the institutional clustering. $150,000 keeps coming up again and again. That is not coincidence. That is the price level where Bitcoin starts to compete directly with gold in portfolio construction. That is the level where Bitcoin stops being an alternative and starts being a strategic reserve asset. If Bitcoin holds above six figures into 2026, it forces every allocator in the world to answer an uncomfortable question. Why don't we own this? But now let's talk about the other side. Because ignoring the bearish case is how people get wiped out. Jurrien Timmer calling 2026 a year off is not noise. It's cycle theory. And cycle theory has not been broken yet. Every Bitcoin cycle has had a post-halving euphoria phase followed by exhaustion. Consolidation is not failure, but it is dangerous for people who expect straight lines up. CryptoQuant's models are even more uncomfortable. They are not emotional. They don't care about narratives. They look at flows. ETF inflows slowing, a minor selling increasing, on-chain demand not accelerating fast enough to justify exponential price expansion. Their models don't scream collapse, but they do scream vulnerability. And then there's the extreme downside, the part nobody wants to talk about. Peter Brandt's 70% drawdown scenario. Mike McGlone's $10,000 mean reversion warning. People dismiss these because they sound insane. But let me remind you of something. Bitcoin has never matured without breaking people first. Every structural transition has come with pain. Here's the core issue that almost nobody is articulating clearly. ETFs did not remove risk. They concentrated it. They turned Bitcoin from a bearer asset into a balance sheet asset again. And balance sheet assets are subject to forced behavior. If ETF inflows slow while volatility spikes, those products don't behave like diamond-handed hodlers. They behave like financial instruments. They rebalance. They reduce exposure. They follow risk models. And when that happens, price discovery can flip violently. Now let's zoom out and talk about what 2026 actually represents. 2026 is not about price targets. It is about validation or rejection of the structural thesis. Either Bitcoin has become a permanent allocation in the global financial system, or it hasn't. If it has, then $150,000 is not the top. It is the floor of a new regime. If it hasn't, then six figures will be remembered as another cycle peak before a brutal reset. This is why the range is so wide, because the market itself doesn't know yet. Look at Bitcoin right now. Tight range, low volatility, rising open interest, spot outflows, defensive positioning by firms. This is not a market preparing for liftoff. This is a market holding its breath. And holding your breath is not sustainable. Every major transition in Bitcoin's history has followed the same pattern. Compression, narrative conflict, violent resolution. The 4-hour charts showing BTC capped under key EMAs are not bullish or bearish on their own. They are a warning. They tell you that momentum is undecided. And undecided markets don't stay undecided forever. When analysts talk about a decision phase, that's not technical jargon. That's a polite way of saying the market is about to choose winners and victims. And here's where most people make the fatal mistake. They think the choice is between up or down. It's not. The choice is between ownership and exposure, between holding the asset and holding a representation of the asset, between being able to wait and being forced to react. If Bitcoin breaks upward into 2026 with conviction, the ETF narrative becomes self-fulfilling. Institutions chase performance, allocations increase, volatility expands upward, $150,000 becomes consensus. Then $200,000 stops sounding crazy. And once that happens, the $250,000 calls stop being predictions and start being late cycle euphoria. But if Bitcoin fails to hold structure, if ETF inflows turn into outflows, if liquidity tightens globally, then something ugly happens. Bitcoin doesn't gently drift lower. It gaps, it cascades. It reminds everyone why this asset terrified regulators for a decade. This is the part people don't want to hear. Bitcoin cannot be both fully financialized and immune to financial crises. If it is in the system, it will be stress tested by the system. And 2026 is shaping up to be that stress test. The reason this feels different is because it is. In prior cycles, retail drove the mania. This time, retail is mostly sidelined. The participation is indirect. That makes the market quieter, but it also makes it more brittle. Quiet markets break louder. So what does this mean for you? It means stop asking which analyst is right. They're all guessing within frameworks that may already be obsolete. The real question is simpler and harder. Has Bitcoin crossed the point where global capital cannot ignore it anymore? If the answer is yes, if the answer is no, then 2026 will be remembered as the year belief outran reality. Either way, this is not a year to be casual. This is not a year to be over-leveraged. This is not a year to blindly trust narratives, because when the market finally decides, it will not give you time to adjust. And that's the real reason Bitcoin 2026 matters. Not because of the price, but because of what that price will prove. The range between $10,000 and $250,000 is not a prediction gap. It is a confidence gap, and the market is about to close it.